Well, what's going to get affected by the elections is the banking sector. Revenue at U.S. banks is shrinking, and the new financial rules are expected to keep on squeezing the profits. So how bad is it all going to get for the industry? Right now, I want to welcome Bahl Gaynor's Matt McCormick, who helps manage $2.9 billion. And, of course, Sheila and Adam still with me. And, Matt, first off, we had this big debate going on yesterday on this program about whether or not revenues are, in fact, going to slow down in the next 10 years. The consensus seems to be yes. But I want to get your take. Do you believe that?
I certainly do, and I don't think this is a one-time trend for last quarter. Betty, when you look at the 16 banks within the S&P 500, they reported this quarter year-over-year earnings growth of approximately 190%, yet they saw top line or revenues decline on average 3.17%. I think this trend is going to continue, especially as we see banks digest the continued impact of FinReg and where they see impacts on credit cards, checking, and other associated fees that are certainly not going to be accretive to revenues or earnings. So I think this trend is, unfortunately, I would equate it into baseball terms. We're probably about in a third or fourth inning, and I think there is still going to be a revenue decline of sustained period, and I don't think it's going to pick up until you see the economy begin to strengthen and loan demand increase.
But isn't there an argument to be made, though, to still buy these banks because their loan provisions are coming down, that they still have that earnings power even if that revenue is on its way down?
I think when you look at last quarter's earnings, that many of the banks, they did obtain earnings beats because they took from the loan loss reserves. That is certainly an aspect of why you may want to buy it. However, I think that's one of the few reasons why I could justify owning them here. I think you look at many of the banks where they're still, as I said, trying to understand the impact of FinReg, which could still, again, be a lag on earnings and revenues. I think when you look at QE2 happening, where that's going to continue to flood the market and lower interest rates hurt them this quarter, and lower interest rates, which QE2 will be a natural derivative of, is not going to help them in the future. And if you look at what's the goal of QE2, which is to flood the market with liquidity and lower interest rates, there's still no loan demand, in my opinion.
Okay. And Matt, it's Sheila Dharmarajan here. Going back to those top line trends for a second, people talk about this sustained period. A, how long do you think the sustained period will be? And B, how much of it is because that banks essentially borrowed from the future during the credit bubble when they saw their revenues go up by a lot?
Sheila, that is a great point. When you look at the banks still paying for the sins of the past, that they are going to be in what I would call a barren wasteland for a considerable period of time. I would say anywhere between 4 to 5 years, because what they have is the environment where it was very easy to make money has gone away. The ability to make money in a recessionary where they used to apply difficult charges or fees to consumers has gone away. Essentially, there are now utilities, in my opinion, where their revenues are somewhat regulated, their pay is regulated, and their returns are going to be marginalized. I think when you look at going forward, what is going to make me make me take another look at especially the money center banks, and in my opinion, only be dividend increases, which I don't think is going to happen anytime soon until the regulatory concerns or the dividend taxation rates are codified.
Hey, Matt, we have less than a minute here, but money center banks versus non-money center banks. In other words, the smaller ones. How do you feel about the smaller ones?
I don't like the money center banks. I'm probably more inclined for regionals, but I'm more inclined to look at Canadian banks, particular Bank of Nova Scotia and Canadian Imperial. They don't have many of the U.S. concerns. You have a commodity-based economy. They have healthy yields at 3.5, and I think when you look at going forward here, I like the Canadian economy much more stronger than the U.S. I really do not advocate owning the money center banks at this time.
Interesting. All right, Matt, we've got to leave it there, but appreciate that. Matt McCormick of Bahl Gaynor.